In exercise 8.21, we're going to do the lower of cost and net realizable value. Now, we're not going to follow the instructions. Instead, what we're going to do is calculate the lower of cost and net realizable value for each month, and then I'm going to show you how to do the journal entries, first using the valuation method, and then second using the direct method. So there's actually two ways that we can record this. But before we get started, I want to tell you what happened before we have to make this decision. So all of our inventory transactions already happened. So we purchased and we sold, we purchased and sold throughout the year. And it could happen either under the perpetual or periodic inventory system. And we already applied either using specific unit method or FIFO method or weighted average method. So now we're just looking at the ending inventory. But before we can actually put our financial statements out, we actually have to test to see if our ending inventory is lower than the realizable value. And I like to call it the street value, because if it's lower, then there's an impairment there. And we'd actually have to write the inventory down to the lower amount. So sometimes the realizable value could be lower than the inventory and sometimes it's higher. So we'll only write it down when the net realizable value is lower. So if I look at February, so I'm just going to set up my inventory account. The cost at February was, or let's just even start with January. So the cost at the end of January was $25,000. And if we're using the indirect method, and that's the way I'm going to do first, it's setting up a valuation account. So it's setting up our inventory account and then another T account for this allowance. And it's like a contra asset account. It's kind of like accounts receivable and allowance for doubtful accounts. And then I add those two accounts together, and then whatever it is, I'll put it as inventory on my balance sheet. So I have my ending inventory, then an allowance, and my adjusting journal entry, or I'll just say adjustment, and then my net ending inventory. I'll say inventory at lower of cost and net realizable value. Okay, so in January it was $25,000, and then you'll notice that the lower of cost and net realizable value is $24,500. So that's the amount I want my inventory to be. So if we didn't have anything past January 1st, I'd start off with 0 in the allowance account. And then if I just take the difference, that means I'd have to make an adjustment into my allowance account for $500. And now let's look at February. So remember, I'm just looking at the inventory account. So February, my ending inventory at cost was $25,100. My opening allowance is basically these two adjustments here. So it's your opening allowance plus or minus your adjustment. And that's actually happening in a separate T account. So I have my opening allowance, my adjustment, if any, to bring this to lower of cost and net realizable value. So in February, the cost is $25,100 and the net realizable value is $17,600. So I need to write this one down. So I can just take the ending amount and then just flip the signs on everything above the line, and that gives me $7,000 adjustment. So right now I have my allowance account sitting at $7,500 and my inventory account sitting at $25,100. And those two together equal $17,600. Now in March, we'll do the same. So my inventory at cost is $29,000. My allowance is basically the opening allowance and the adjustments from the previous month. And then I don't know what my adjustment is going to be yet. And then my inventory at lower cost and net realizable value is going to be, it looks like $22,600. That's the lowest. So remember, we're only writing it down to either the lowest in the inventory cost or the lowest in the net realizable value. So in all of these situations, it just so happens that net realizable value is the lowest. So that means I have to adjust for $1,100. And then in April, my inventory cost is $23,000. My opening allowance is the allowance plus the adjustment from the previous month. And then my adjustment that I'll need to make will be for this month in order to bring this to I guess $17,300. That's the lowest in April. So now that I have all of my adjustments, what I'm going to end up doing is my journal entries. And remember, this is the indirect method. And I'm going to prepare the journal entries from January until April. So I'm just going to highlight in yellow that these adjustments are going to be the journal entries. So when we use the valuation method, so I'll do debit. Instead of directly adjusting to cost of goods sold and inventory, we're going to adjust to loss on inventory due to decline in net realizable value. So that's the adjustment we'll put through on the income statement. And then we'll credit the allowance. So don't credit directly the inventory account. We'll credit the allowance to reduce inventory to net realizable value. And in January, the amount that we're doing is the $500. Okay, and the way that I like to think of this is the allowance account. So if it's sitting as a negative there, think of it as a credit anyway. So you can think of these as debits and credits as well. So that's how I know to credit my allowance account. So that's for January. Now in February, I'm just going to see if we're doing the same journal entry. So we're going to credit $7,000 to the allowance account, so I can copy these journal entry names. And then I'm going to use the $7,000. So then you can see by the end of February, I have a credit and a credit. So I have $7,500 sitting in my allowance account. Then in March, I have an adjustment. So I'm going to have to debit that allowance account for $1,100. So I'll have to switch these journal entries around. So I'm going to end up doing a debit to the allowance, and then I'm going to credit against my loss. So then that's going to actually be like a recovery on my income statement. So just notice that this one is backwards because I'm debiting that allowance account and not crediting it. And then we'll do April. And I'm again doing a positive adjustment, so I'm going to debit that account. So I'll just use this journal entry. Okay, so I'm actually going to show you all of this information again, but in T accounts, just in case you look at T accounts a little bit easier. Okay, so I created a T account for inventory, a T account for the allowance, and then when I add them both together, I'll get my total. So let's start from the beginning again. So I had 25,000 in inventory, and then I made an adjustment of 500. Then that total together gives me 24,500, and that's the number that I want here. So a bunch of transactions happened throughout February. So then my balance in February is 25,100. So I just want to remind you that we don't do a journal entry for this $100 just because a whole bunch of journal entries would have happened between January and February from purchasing and selling. So we're at the 25,100, but I just want to let you know that there's still a balance of 500 in that allowance account. And what we want is for it to be sitting at 7,500. So remember I said to make an adjustment of 7,000 credit. So then if I have the balance sitting at 7,500, then when I take 25,100 minus 7,500, that gives me 17,600, which is the amount that I want. And then we'll do it again. So in March, we have a bunch of transactions occurring during the month, and then my inventory ends up being at 29,000. And then my allowance, we're going to make an adjustment on this side for 1,100. So now my new allowance balance is 6,400. And so if I take my 29,000 minus the 6,400, then my net inventory is 22,600, and you can see that there. And then in April, again, we had a bunch of transactions, and my inventory ended up being 23,000. And then my allowance adjustment, we said would be the 700, and that's a debit. So if I take 6,400 minus 700, my allowance account is sitting at 5,700, and then take your cost minus your allowance, and then that'll give us a net of 17,300. So just do it the way that is easier for you. If you want to put them originally through T accounts, go ahead. Or if it makes sense just putting it into a schedule, go ahead. But we'll end up with the exact same journal entries and then the proper amounts in our ending inventory anyways.